All right, if you could do me a favor, if you are not muted, if you could please mute. For those of you who don't know, this is always recorded. We have to submit it to compliance. And then once compliance approves it, we can put it out on the website and make it accessible for you or for others to view and listen to after the presentation's been completed. And if you are muted, then it is far easier for us in terms of editing. So again, if you don't mind, please just taking a moment to mute yourselves. All right, so thank you for joining us. It's obviously a beautiful day in upstate New York, absolutely gorgeous. I think it's supposed to be in the 70s today. It's always the same temperature from these windows though, but when the sun is shining, it sure feels really nice. Great views here. I'm going to talk about that again in a moment. But today I wanted to talk a little bit about obviously what's going on in the markets. And I'm going to touch on a handful of things, not just the markets as most of us think of them, the S&P 500, but also talk a little bit about what's going on internationally, what's going on with the bond market. And I think you will agree by the time we complete this that there are some very interesting opportunities out there and obviously some very interesting things that have occurred. Let me take you first to the, what we all know, the S&P 500. I want to talk a little bit about the S&P just to make sure that we're all on the same page in terms of understanding not only what the S&P has done, but what makes up the S&P, because a lot of people, this is still kind of foreign territory. So the S&P 500 has long been the index that's tracked for research purposes and for a general benchmark of the US equity markets. The S&P 500 actually represents the largest 500 stocks in the US market. And looking at this chart that dates back to nearly 30 years, we've actually seen quite a few periods of volatility in that 30-year period. And as the S&P 500 has reached a high point, the price to earnings ratio has ranged from about 15.1 back in October of 2007. Oh, if you look here at the 15.1, right? And then it ranged as high as 25.2 back in March of 2000. So here you are at 25.2 times earnings. The peak of the tech bubble, of course, is what this point is recognizing, the 25.2. The S&P 500 bottoms have ranged from as low as 10.4 back in March of 2009, here you are at 10.4 times, to where we currently, actually the highest low point was 15.9 back in December of 1996, and we currently sit at about 15.1 times earnings. So that would be really not an expensive market, but also not an inexpensive or a cheap market. And keep in mind that this is specifically the large cap US marketplace. As I mentioned, the current price to earnings ratio for large caps is not expensive. It's also not inexpensive, but here we see it versus the 25-year average of 16.84. So one could consider it to be moderately inexpensive in today's economy. We've seen large caps that hit this price many times in the past, and most recently in early 2020. Prior to that, it was in late 2018 where we saw the downturn as a result of the tariff battle between the Trump administration and China. In both those market environments, we were fortunate enough to see a very substantial bounce in valuations, leading to significant market growth. Keep in mind, valuations are only one indicator of the market's direction. There are several other pieces that go into that puzzle. Now, October has always been a special time of year. Upstate New York welcomes the fall season with the absolutely beautiful change in the trees and my son's favorite holiday, Halloween. And if you've not had an opportunity to see the fall landscape from our office, you should really take a few minutes if you're in the area and stop by and get a glimpse. It's truly remarkable. While we certainly enjoy the view in the fall, the stock market, on the other hand, enjoys the month of October far less. As a matter of fact, the Dow Jones Index, the S&P 500 Index, and the NASDAQ Index have all seen far more market bottoms in the month of October than in any other month. The Dow Jones has actually realized 4 times more market bottoms in the month of October than in any other month, while the S&P 500 and the NASDAQ have seen about twice as many bottoms in the month of October. Now, the S&P 500 is made up of 2 primary asset classes, value and growth. In general, value stocks tend to be companies in the healthcare, financials, industrials, consumer staples, materials, energy, and utilities industries, while growth stocks tend to be companies in the information technology, consumer discretionary, and communication services industries. Growth stocks are generally companies that have had 5 years of average sales growth of above 15%, while value companies typically have a price to sales ratio that is below 1%. Either stock may pay a dividend, but typically the dividend of a value stock is not only more likely, but also higher. In recent years, growth stocks have substantially outperformed value stocks, but that has not always been the norm, as we often see periods of value stocks outperforming. This chart is helpful in demonstrating time periods where value stocks may very well outperform growth stocks for the foreseeable future. And as you can see, we've seen a few years of undervaluation of value stocks. The first half of 2020 reflected a shift from growth to value in the S&P 500, but that reversed course as that year carried on. 2022 has seen a similar shift, but value is kept right on. Although the US equity asset classes are all negative, value stocks have seen a far less challenging downturn than have growth stocks. Here we have the valuations, along with some interesting rate of return by asset class details. And let's start with the valuations that are on the right-hand side of the screen. The top number is the current price to earnings ratio for the asset class, and the bottom number is the 20-year average. Looking at every single asset class, you can quickly see that large cap growth, right up here, right, is the only asset class that remains expensive versus its 20-year average. Interestingly enough, take a look at small cap growth. That is by far the least expensive, 22.8 versus its historical average, its 20-year average of 34.1. Now, mind you, small cap growth is the most aggressive domestic asset class. And while it may present the most opportunity on the upside from a valuation standpoint, it also has the greatest potential for loss, especially in an increasing interest rate environment. Looking at the two charts on the left side, we see the 10-year annualized over here. Right? This is the 10-year annualized returns of growth far outweigh that of value on the large cap side by about 4.5% annualized. Here you have your 13.7 10-year number versus 9.2 for value. Right? Year to date, it's quite a different story where value has been far stronger than growth. As a matter of fact, by nearly 13% year to date. It's also interesting to see the returns since the market peak in February of 2020, coming down here, the market peak. And you can see since that market peak, growth has outperformed value by a significant number, almost 8%. Mm-hmm. But it's a bit of a different story when you just go 1 month later to March of 2020, and you start this snapshot or this picture at the market low. Value has actually outperformed growth by about 6 points. And take a look on the small cap side, small cap value up 90% versus small cap growth up 51. That's a 40% difference, just about a 40% difference. So it's been fairly substantial in terms of the results on the value side. I've always found this piece of great value. We're going to look at this a little bit later when it comes to bonds, but this specifically is in relation to the S&P 500. What we often forget is what happens throughout the year when we're fortunate enough to finish a year in the positive territory. But every single year comes with volatility. And what this chart does is reflects the S&P 500's performance year by year in the black bar chart, with the black numerical value representing the rate of return for the year. The red numbers represent how much of a downturn occurred from the market's peak that year to the market's bottom. And as you can see, most of the last 20 years have had a double-digit decline within that year, even if it finishes the year in positive territory. This piece really goes a long way in explaining why market timing is pretty much impossible. And that's the very reason we not only stay invested, but also approach investing with a focus on diversification. Let's talk for a minute about how unique the year 2022 really is in terms of history. There are many charts that appear distorted as a result of the substantial efforts to address the COVID crisis. Some of those charts are in today's presentation. This one in particular really drives home the point of how significantly the market environment has been impacted. There have only been 5 times in history since 1928 that we've seen the full year end with the S&P 500, the 10-year Treasury, and a 60% equity, 40% bond portfolio ending negatively. 1931, 1941, 1969 were all rather challenging years in the market. We then saw nearly a 50-year period before we experienced this again in 2018. We didn't get a 50-year break this time, as a mere 4 years later, we're anticipating 2022 to be marred with the same frustrating result. That is by far the shortest time period between such volatile results. Now, if you look closely, in all years with the exception of 1931, all three of these investments saw strong results for the 2 years that followed. And there are many things that indicate that the same may be ahead for us. Let's first look at consumer confidence going back to the early 1970s. We recently hit a low point in the consumer confidence numbers, the likes of which we have not seen since 1980. Believe it or not, the consumer confidence level fell below where it was in 2008, when we were facing potential financial collapse as a nation. I find that hard to believe as I do not see things being nearly as problematic for our country as they were back in 2008. In 2011, we saw another drop in confidence as a result of US debt being downgraded. And in previous time periods where we have seen such a dramatic drop in consumer confidence, it was followed by a sizable improvement. At times, that improvement lasted only a couple of years, but in most cases, it extended for 4+ years. There's no telling when we'll see consumer confidence strengthen to at least the average of 85, but if history is any indicator, we should start to see a steady improvement to that, and that will continue hopefully for at least a couple of years. As we wait for our confidence to improve, we must contend with the markets and the economy at hand. I've been at this for 25 years come January, and the one thing that I've realized is that all bear markets are exactly the same. The cause for the bear market may be different, and actually it's always different, but all bear markets are the same in that they have a tremendous impact on our emotions. While it's easy to recognize the value that a large sale presents at our favorite shopping establishment, it is far more difficult to recognize that in our portfolio. When you own something prior to it being on sale, it is admittedly more painful to see it go on sale because you would prefer to always get at least the highest value at which you ever own that particular item. We know that is just not the case in life, whether it be a piece of technology like our iPhones that we bought a year ago and are worth nothing now, or positions in our portfolio. In times like this, our role is more important than ever. We must consistently review every single position in your portfolio to determine if we should hold that position, put it on our watch list, or put it on our replace list. Believe it or not, the most difficult decision is to determine if it should go to our replace list. Sometimes that decision is easy if a manager has changed courses, has adjusted their philosophy, has left the fund, or whatever it might be. But when a manager has had a superb track record and shown great results in a rebounding market, but has suffered significantly during a downturn, the decision becomes far more difficult. We have two such positions in most of our clients' portfolios, and those are positions that are responsible for many hours of missed sleep for our team. We continue to monitor them at least weekly, speaking to the managers or their representatives on a regular basis, and keeping a close eye on the actions of the fund to ensure they maintain their philosophy, act as they did during previous downturns, and retain top positions that we see as being important in the recovery. I thought you'd find this chart helpful, and that it is clearly demonstrating the rewards of resiliency in the markets. Staying invested is never more important than it is in a down market. So I just wanted to point out here, and I think this is probably clear, but looking at the declines and then 1 year from trough, 3 years from trough, and down at the bottom here, the average rebounds. This slide gives us a pretty interesting look at the rotation from domestic equities to international equities over time. We've just experienced the longest rotation to US equities in history, lasting 15 years so far. The next longest rotation to domestic equities lasted a mere 6 years. So the question is, could this be the new norm? Or could this extended US dominance be taking its last breaths? In order to get our arms around this, I think it's important to understand what one of the biggest influences in these rotations has been: the rise and fall of the US dollar. Looking at the chart on the left, going back to the late 1970s, you can see that the value of the dollar rose consistently for several years, and the impact on US stocks was substantial rising about 106% versus the international market gains of only 49%. Right? And those are represented by these numbers here, just to point them out. Okay. We then saw a decrease in the value of the dollar that lasted slightly longer and was coupled with a substantial run in international markets being up over 430% versus the US being up only about 340%. This cycle clearly repeats itself over time. Take a look at the chart on the right-hand side. We see here the most recent change in the value of the dollar, with the dollar dropping a bit in 16 and 17, but then rising, only to drop a bit again in 2020, followed by a very dramatic bounce from the 2020 US dollar lows. We were speaking with a client last week that is headed to Europe, and they're ecstatic about the exchange rates versus their last visit. Several years ago, the exchange rate was $1.42 for €1. Today, it's about even. Looking just over our border to Canada, there was a time not too long ago where we were at about par with the Canadian dollar. But for a few of you on this call, we know that the Canadian dollar is in the mid-70s versus the US dollar. Few and far between believe that the dollar can maintain the stronghold that it has on foreign currencies without causing substantial international strife. Will the reversal of the dollar value pave the way for international emerging markets to spring from their extremely low valuations and dismal decade of performance is the big question. Let's look a little bit more international. Supporting for the argument for an international rebound is the valuation of 10.8 versus the 25-year average of 13.1. The US is far more expensive, trading at a price to earnings of 15.1 versus a historical 25-year of 15.4. From a dividend perspective, international also has a stronghold over the US with nearly a 2% stronger dividend. Three strong indications: the US dollar value, price to earnings ratios, and dividend yield all support the rise of international equities. We've maintained a reduced exposure to international, but we do anticipate increasing that over time as we see a rotation from US equities to international equity. One more snapshot of international markets. Earnings growth projections over the next couple of years are the strongest in China and emerging markets in general. Valuations are most discounted in Japan and Europe. Japan has suffered a valuation crisis for decades, a unique aspect of that country that I feel is best explained by their culture. I'll spare you the details of the Japanese Kiritsu, but that is a big reason for this. If you're interested, Investopedia has a great piece on the Kiritsu for those of you who want to research it further. China and Europe present potentially attractive opportunities as we move through the current crisis facing each. Keep in mind that the best point of opportunity is not when the crisis has passed us by, but instead at some point in the midst of the crisis. We will continue to research these opportunities and maintain some exposure to them, increasing that exposure as the environment seems fit. Let's now shift to bonds. This has really been one of the most interesting years in bonds in history. We've seen most bonds get absolutely slaughtered in this market environment, some bond asset classes having had their worst performance by fourfold. US credit is down a miserable 19%. Given that so many investors carry bonds in their portfolios to support the downturn in stocks, this has been a true wake-up call for investors and advisors alike. If your portfolio was invested 100% in US credit, you should be down over 19% year to date. It's rare to see folks allocate 100% to bonds, as they usually include an allocation of various stock asset classes to better diversify their portfolio and to ensure it is addressing inflation. Considering the majority of stock asset classes are down between 22% and 31%, that means even the most conservative investors are likely down over 20% in their portfolios. Recall the slide that we looked at that reflected the negative results of the S&P 500, the 10-year Treasury, and the 60/40 investor. We have only seen the three of these negative for the entire year, only 4 times going back to 1928. Again, this year potentially being the 5th. Taking a look at interest rates today and where they were a year ago, I don't think there's anyone who would have guessed there would be such a dramatic shift in rates. From a 20-year mortgage at about 2.9% a year ago to about 7% today, more than double the interest cost on a mortgage. Look closely at this chart. The 1-year to the 10-year rates are higher than the 30-year rate. An interesting inversion to the yield curve, to say the least. Now, as yields go up, what we have to recognize is they have a negative impact on the value of bonds. And looking at the difference in yields versus last year, there has been virtually no bond spared in this interest rate shift. This is one of those rare occasions where you would have been better off investing in large cap value stocks than in bonds over the last year. Given this shift and the increased yields in the bond marketplace, we believe there are some great opportunities on the bonds on the horizon. Let's take a little closer look at the bond market. The longer a bond, the more significant the negative impact of an increase in interest rates. And we can really see that pretty clearly with this chart. At the top, you have 2-year treasuries, and 2-year treasuries are down about 4.5%, while 30-year treasuries are down a whopping 31% year to date. The bottom half of the chart reflects different types of bonds, with the worst performances being found in convertible bonds and investment grade corporate bonds, also known as IG bonds in our world. Oddly, US high yield bonds have actually performed better than investment grade corporates or convertibles, and that's a very rare occasion. The strongest bond asset class has been the leveraged loan bonds, also known as floating rate or senior secured loans. For those who pay close attention to their portfolios, we took a position in these about 18 months ago to help protect client portfolios and especially to help insulate those who are in or are near the distribution phase of their portfolio. We are pleased to have had a strong result here, but are also of the opinion that we may soon need to leave this asset class that's been so good to us. There are several different types of bonds in the investing world, and each of these bonds acts a little bit differently under different circumstances. This may appear a bit confusing at first, but what it is reflecting is how various bonds have responded once we are faced with an inverted yield curve up until the end of the recession that follows. Remember, most inverted yield curves are followed by a recession. Not all, but most. Here you can see that the bank loans or the leveraged loans floating rates tend to underperform other bond asset classes as the recession forges on. The strongest reason behind this is that defaults increase. And as they increase, the floating rates often experience the higher number of defaults on their notes. This is one reason we are closely monitoring this investment and expect a trade away from floating rate in the not too distant future. A little bit more on bonds. Another reason is that the yield to worst that we are seeing in other bond asset classes are at or near all-time highs versus the previous 10 years. Take a look at municipals in particular. They present with a great opportunity no matter what one's income level is, given the taxable equivalent. Investment grade corporates are also quite attractive. Leverage loans on the far right still present attractively at 10.5%, but they're far from their 10-year high yield. One also has to take into account the underlying risk of the bond to best determine if the yield is justified. And that gap is closing with the leveraged loan positions, in my opinion. Just to make sure this is clear, the 10-year range is represented by the black bar chart, right? So here's your 10-year range, the 10-year median, and then the current is represented by the diamond. And here you can see that all these are pretty much at or near their 10-year high in terms of yield. Now, taking a closer look at the municipal marketplace, this chart reflects the tax equivalent yield on muni bonds versus the US Treasury yield. A spread of about 1.9% on the short side and an incredible 3.7% on the long side presents an attractive entry point for bond investors. And we feel that we may be taking a much bigger position here once we see the next rate increase. This is my last point on bonds, at least for today. I really thought it would be helpful to show you how historically significant the 2022 bond market has been. Now, this dates back to 1976. And yes, we saw a similar chart just a few minutes ago with regards to the S&P 500. But this one is showing in the black bar chart how the bond aggregate performed in each respective year, with the black number reflecting the actual performance for that year. The red number reflects the downturn from the bond aggregate's peak for that given year. As you can see, since 1976, we have only experienced 4 down years in the aggregate bond, not including 2022. Even more interesting, looking over those down years, but also the downturns in any given year. The worst was that -9% that you see back in early 1980. But the majority fell at about a -2% to a -3%. 2022 is clearly at -15% as of September 30th, and it has fallen more from there in October, being down about 19%. I think this piece really makes it clear how truly dramatic the sleepy bond market has been for 2022. All right, let's turn to the economy. So I think the media has done enough talk about the economy that you probably don't really need to hear too much from me on the topic. But many times the media focuses on how to best get your attention as opposed to how to best educate you on what's going on. And if you were to ask me, I would say that we are likely already in a recession. Typically, you really don't know if you're in a recession until well after it started. And if we look at the leading indicators, we can see that the three most influential, the weekly manufacturing hours worked, ISM index of new orders, and consumer expectations, are all suggesting a recession is on the horizon. My guess is that we'll see others turn in this direction as well in the coming months, most likely yield spreads being the next to fall in line. Let's look at those yield spreads, and you'll see why I say that. This is the 50-year yield spread chart, reflecting the movement in the yields as well as recessionary periods in gray. More specifically, this is showing the 10-year yield minus the 3-month yield. As we see the result get smaller and go negative, which it is currently, we have historically seen a recession follow not too far behind. One last comment here. It is important to differentiate between the economy and the stock market. The stock market's a leading indicator, and the economy is a lagging indicator. They are not one and the same. We typically see the markets recover well before the recession comes to an end. Now, it's always interesting to see when cash positions increase versus where we are in the market. The most recent increase was substantial, and this was no doubt influenced by the amount of money pumped into the economy by the government to keep the economy moving through COVID. If you look back at 2000 to 2002 and at 2008 to 2009, you can see that many substantially increased their cash savings by a large amount. This is the mere act of selling off investments and having it go to cash. And these are the absolute worst times to increase cash positions. Those times coincide with substantial market downturns and reflects, again, people selling out of the markets when they are down, only to return that cash to the market when the markets have improved. This is the exact opposite of what investors should be doing if they wish to make money on their money. I had some hesitation to include this slide, only because I assume that it will stir up some conversation. But the reason I wanted to share it is to help make the point that the stock market is mostly agnostic to red or to blue. If you look at the box at the top, it helps make that point very clear that it just doesn't matter what party is in control over the duration. And you can see here that during blue times, these January to 09 to January 17, 16.3% return, January 17 to January 21, 16% return. Here they are on the negatives, etc. Now, interesting enough, midterm elections do seem to have some consistency in the days leading up to the election and the days following. So check this chart out. So here we're looking at the midterm elections, only a few weeks away. We can see that the amount of volatility in the markets tends to reduce as we get closer. And since 1946, they have never been lower 1 year after the midterm election. Now, I'm not convinced it has all that much to do with the elections, given the range of performance, but nonetheless, I did find this rather interesting, and several folks have asked me what my thoughts are with regards to the midterm elections. Here, I just want to point out is that 1 year and after the election, here's the election, here's the time period leading up to it, and this, you can see, is positive returns, negative returns, all charted going back to 1946. All right. Interesting enough, post-election, not nearly as many negative returns. And again, just to point out, 1 year after, historically speaking, has never, since 1946, been negative. All right, pretty much all of you have seen this piece from me before. I found this piece in 1999, and I have carried it with me just about everywhere ever since. And here's what it all comes down to. It really all comes down to our emotions. And investing, without a doubt, is one of the most emotional aspects of our lives. When things are good, we all feel pretty good, and we're all pretty upbeat and optimistic. And when things are not so good, we tend to feel all the pain and suffering that the world has to offer. And of course, the media is very helpful on both sides of this, letting us know that what we missed out on when the markets are strong and what we should have done before the downturn occurred. I'm quite confident that we are somewhere in the range that I circled here, with the hope that we're on the far side of despair. Anytime you are feeling the pain, that's what we're here for. And we'll encourage you to reach out to us with a call or an email so we can schedule time to discuss your portfolio and how you're feeling. Our goal is to help protect you from making the mistakes that so many investors make over and over and over again. And this is a great piece that really references those individuals who make those mistakes over and over again. So looking more closely at those mistakes, there is a common piece we see. This is a very common piece that we see from various firms in our industry. I just happen to take this one from JP Morgan. And what they do is they consistently look back at the 20-year period that most recently ended, this one being December 31st of 2021. And they give a snapshot of the various indexes and then reflect the average investor performance over that same time period. And as you can see, the only indexes that have done worse over the last 20 years than the average investor are inflation, commodities, and cash. We do not want you to be the average investor, and we will work diligently to help you through both the good times and the challenging times. Now, as I reviewed the latest Goldman Sachs market commentary, I took an interest in this piece. This gives you a clear picture on how unpredictable the market is if you just looked at it in the first half of any given month versus the second half of any given month. As a matter of fact, take a look at June. I underlined it here. Historically, the second half of the month has been softer than the first half of the month by a pretty substantial amount. Now, keep in mind that these are median numbers and certainly not information that you would want to use to determine how to manage your investments. What is most important is to recognize that often the worst periods of the year are frequently followed by the best periods of the year, and missing out would have a devastating impact on your portfolio. Let's take another look at the impact of missing the strongest periods in the market. This is a snapshot of the 15-year period ending December 31st of 2021. Over that time frame, had you stayed invested in the S&P 500 for the entire time, never touching your money, you would have grown a $10,000 investment to over $45,000. Now, along the way, you would have had to suffer through some pretty significant turbulence. The Great Recession of 08-09, where the S&P fell over 50% during that time period. The downgrading of US debt, Brexit, which a lot of people don't even remember hearing about, but that's when the UK left the European Union. The Trump administration and China battling over tariffs. COVID, which hasn't even yet earned its green box in this chart. But let's look at what happens if you miss just a few days of that 15-year period. So the first part of this chart in the green, you can see is the exact same information from the previous slide. But immediately under that shows the difference if you were in return, if you were to have missed the best 10 days in that 15-year period. Let me emphasize that this reflects missing only the 10 best days in that 15-year period. Your return gets cut by more than half, and you end up with just over $20,000 instead of that $45,000. Now, I'm a bit of a cynic when I see pieces like this, so I posed the question of how this is even possible for someone to miss the 10 best days to Putnam, who's the company that provided me this piece. They responded that it's actually quite common because in more than half of the best days occur within 10 days of the worst days. Let me repeat that. It's common because more than half of the best days occur within 10 days of the worst days. So for those who sell out during a downturn and go to cash, they're on the sidelines when the majority of those best days occur. That takes me back to the average investor and why their results are so dismal when compared to the various indexes that we saw just a few slides ago. All right, let's turn our heads to inflation. The biggest contributors to the increases in inflation based on this chart would clearly be housing and energy. Food, of course, has also had a pretty substantial impact, while new and used vehicles have actually softened in the last few months. Here's the good news. inflation expectations from both the consumer and professional expectations are a relatively tame 2.7 and 2.8, as you can see on the top right. I suspect we will see several of these areas come down in the coming months. I do believe that the inflation that we saw in some areas will be locked in at their new higher rates unless demand forces them to reverse course. It's important to remember that the inflation measure is a year-over-year number. So just as an example, if we see an inflation number of 8.1% a year from now, that would mean that the 2-year number would actually be over 16, given the most recent reading of 8.2, right? That's a year-over-year number. Going back to 2007, we've seen the movement of the global supply chain pressure index and the CPI pretty consistently move in the same direction. That changed wildly starting with the early months of COVID, with the CPI dropping, while supply chain pressures obviously skyrocketed. Things were back on track for a period of time, but in recent months have seen a dramatic reversal, with strong improvements in supply chain pressure, but the CPI increasing. The decrease in supply chain pressure is a strong indicator of where the price of goods is heading. And here we are. As a matter of fact, as we all know, we saw a huge spike in the price of goods for a period of time, which peaked in early 22, but has since reversed course and seen pretty substantial decreases. The price of goods is expected to continue its downward trend, leading some analysts to be concerned about a deflationary environment in the future. As we have seen the decrease in inflation on goods, we have seen an increase in the level of inflation in the service sector. Keep in mind, the service sector represents the largest sector of the global economy and includes consulting, training, housekeeping, nursing, teaching, etc. As a result, if the level of inflation in this sector is not tamed quickly, the overall inflation number could get worse. Many expect that the service sector inflation level has already started to correct. The next reading on November 10th will certainly be an important one in determining not only the direction of both service and goods inflation, but also the direction of the Fed for their December 14th meeting. The Fed's next meeting, mind you, is November 2nd, and the majority are expecting them to increase by 0.75%. What will be more important in that meeting is the guidance they provide looking forward. Inflation's been experienced by pretty much all countries across the globe. However, if you look on the far right-hand side, you will see that a few countries have been spared, including China, Indonesia, and India, who have experienced far more mild increases in inflation than most. Now, as you can imagine, the worst levels of inflation are among the European countries, including Greece, Spain, Italy, France, and Germany, thanks in most part to the increased cost of energy. What many may not know is that the highest level of inflation has been felt in Russia, with over 14%. All right, in these last few slides, I thought you just might find of interest the level of inflation in various areas of our economy. We all need food, and no doubt we've all seen a significant increase in our food budget. The latest reading on the percent change in food costs came in at a whopping 13%, which is not yet reflected in this chart. Going back to 2010, though, the average rate of increase has been only 2.5%. But that just makes this 13% increase that much more painful because we are not used to large increases in our food budget. I found the chart for the cost of medical care pretty interesting. If I were to guess, I would have thought that the cost of medical care would have been increasing at a faster pace over the years. This certainly does not take into account the cost of health insurance, or so I presume, but the recent reading is actually in line with the average going all the way back to 1985. We're seeing a pretty substantial increase in the cost of rent and shelter, and I'm sure that's no surprise to any of you. We saw increases of this nature back in the late 80s, and what followed was a pretty big drop in the early 90s in these costs. Of course, the big drop in the chart occurred as a result of the 2008 financial crisis, but keep in mind that this is for residential properties only, and I would assume that the chart for commercial rental rates and occupancy levels are very dramatically different than what we're looking at here. The direction of housing is often predictable based on the amount of activity that exists in the mortgage industry. And parts of both 2020 and 21 saw dramatic increases in the number of mortgage purchase applications. Note that this does not include refinancing applications, only new purchases. This would indicate a slowdown in housing is imminent, which many of us would probably expect given the increase in mortgage rates. Finally, this is a piece that I wrote up a few months back, but the 1990s brought many investors great confidence in the markets, leading most to take a substantial level of risk in their portfolio. The 2000s crushed that confidence and devoured the gains of the 90s for many of those same people. The last decade reinvigorated confidence in people that had not been seen in 10 plus years. And a short 12 months later, and once again, confidence is shaken. We'll find ourselves in markets that build our confidence, but we'll also find ourselves in markets that require great courage. These markets are equally important to long-term investment success. Our approach has proved successful throughout the 2000s. While the approach will not always be successful, short time periods, and unexpected and dramatic volatility, we are very confident that we will be successful through the peaks and valleys as long as we work together with you to ensure that your confidence in our process continues. The great challenge will be managing the emotions involved in investing. But we want to thank you for the trust and for the confidence that you place in our team. With that, I'd like to just open up for questions and comments or thoughts for many of you who've been kind enough to join us today. Feel free on the bottom left to click the unmute button. And one last thing, if you don't mind, we would also really appreciate your feedback as to what you found most valuable in this presentation. It's a real struggle to determine what should go into the presentation without, with all due respect, going over a lot of people's heads and also not making it too basic. We have a great mix of individuals that are with us today and who will watch this in the future. And your feedback as to what pieces were the most valuable will be really helpful for us to put these together in the future. If you do not wish to speak out, you're welcome to send a chat in the bottom of your screen. If you scroll over, you should see a chat button, and just be sure to select me only if you want me to be the only person who sees it. I've got the chat box open. You're welcome to click your mute button and join in.
John, I have a question. So my question goes to inflation and the price to earnings ratio. Does the fact that inflation has been about 8%, does that impact the price to earnings ratio construct?
That's a very fair question. And if you look back over history, you will find times where it does, but it's so inconsistent that it's not a chart that you see very often. You can still have time periods of high inflation where companies have very good earnings. So there's not really a great correlation between the two.
Thank you for the overview of the bond market, as well as the some things that have been a little confusing to me regarding the infusion of the yield curve and why that's important, particularly now. So thank you very much. That was very very instructive. I am concerned though about the energy inflation that seems to still be with us and seems to permeate every other endeavor, including transportation of food, heating oil for homes, etc. Where do you see that heading?
Well, I don't know about some of your locations, but those of you who are in upstate, we received a word from National Grid that we should expect 39% increase in energy prices this winter. That's obviously a pretty dramatic increase from where we're at already. I've taken some steps on my own, to be perfectly honest, and the Biden administration worked diligently to pass some new tax credits for those who do add to their residence or secondary residence. We actually put on solar panels. Not that I advocate for that, but if you're putting on things like an addition to your home or you're building a home, I think it's very much worth considering, because you also get that credit for anything that has to hold those solar panels up. Not everything that, so not siding, not windows, but anything that's required to hold the panels up in the air. And that could turn out to be a pretty significant credit, where you end up with a positive net number for the cost of the solar, and then you get a nice discount on your energy bill. Our savings is 65% of our energy costs. So I do think you're going to see an increase in people who are investing in solar, maybe wind, etc. You know, I don't think those things on their own are all that efficient unless you get the benefits of tax credits, and that's why, of course, the government has chimed in there. I do think we're going to see problems with the cost of energy going forward until we see some resolution overseas with what's going on with Russia and Ukraine. Somebody just posed the question if, in my opinion, that the Fed was too late in raising interest rates. I think it's become very clear that they were actually quite late. Now, I don't think the Fed would have had to increase rates if so much money didn't get pushed into the economy. There was just way too much money that got pushed into the economy. I had some great slides that I was going to share with you today on that, but we had to slender this puppy down because there's just so much to present. But just to summarize one slide, we have about 50% of the money that was pumped into the economy yet to spend. Now, most of you and I didn't benefit from that, but the lower income households benefited dramatically from that, and they still have way more money saved than they ever have in history. So we probably are going to see some continued spend in that respect. As you saw from one of the slides, the shift from spend has moved definitely and very clearly from goods to services. So keep an eye on services. I'm very curious to see what the inflation rate is in services in the next reading. Another question is with regards to REITs that has just been posed on the chat. And I'll just read it to you. As the REIT sector seems like it is doing okay, have you increased anyone's exposure to this sector? Interesting you asked that. The traded REIT sector has actually been one of the worst domestic performing equity classes, down about 32% as of a week ago. So the REIT sector did very, very well last year, up over 40%, and it's just gotten slaughtered this year. Now, with that slaughtering has come an improvement or an increase in yields. Please don't be fooled by the non-traded REIT sector or the REIT sector that does not have daily valuations. Those, I believe, are very misleading, and a lot of those are up 2%, 5%, 8%, 11% year to date. That's very misleading because those valuations do not occur on a regular basis like they do in traded REITs. And if you buy into those now, it could be the worst time to buy into those. Those will more than likely get corrected as a result of the lagging impact on their valuations. Another question posed to me on the chat: are mutual funds still sitting on large cash positions, or are they deploying it? We've seen a little bit of a mixed bag there. So why do funds end up with high cash positions? The reason is because they have to satisfy redemptions. And other reasons, it could be just a positioning effort as they sit on the sideline to buy an opportunity that they see coming up. So it's really kind of a mixed bag in terms of that answer. But we are not seeing cash positions as high as they were 14 years ago in 08, 09. As a matter of fact, we haven't seen cash positions nearly, not even half as high as they were back then. And I'm kind of happy about that. Our preference is to always see the managers of the investment stay as fully invested as possible. Anybody have feedback on what you thought was most valuable? Or if you don't mind, send me an email, or you want to give a phone call and let us know.
I think this was an excellent presentation, John.
Thank you. Anything in particular you thought was most valuable?
I like the bond discussion a lot because that's been very confusing to me as well.
To a lot of people. And, I kind of threw in there the sleepy bond market. It's just that so many people underappreciate the bond environment because it does move slow.
Well, I think one of the slides that you hit, I'd like a quick comment if you can. I think you had a slide there that said municipal bonds return was 8.6%, and that's tax-free, correct?
Yes, you're referring to the yield, not the rate of return, though.
Okay, there you go. That's why I'm confused.
Yeah. So let's just to make sure we're all on the same page on bonds. If yield goes up, bond values go down.
Okay.
Work the opposite, right? So yields go down, which they have for 40 years straight. Bond yields have gone down, and bond values have gone up for literally 40 years, ending in September of 21. Right? Those of you who were around in the 80s and had a mortgage, you remember your mortgage was double digits, right? 15%. My father told me his was 18.1% on his first mortgage in the early 80s. I forgot what year he said. Well, of course, those mortgage rates continue to come down for years and years and years and years, and up until September, well, actually about Thanksgiving time of last year. And then as we see those reverse course, now you see the values of the underlying bonds, MBSs, mortgage-backed securities, have gotten decimated as a result of those numbers coming up. Thank you, folks. Several are sending us notes on the chat about what you most valued. service industry versus goods costs, inevitable downturn in housing, yeah. The review of the various asset classes, yeah, value versus growth.
Well, John, I got a quick comment here. So let's just say hypothetically, you had $1 million under management. And let's pretend your portfolio went down 15% year to date. That would mean, I think your portfolio would be at $850,000. Is that right?
Correct.
So with 8% inflation, help me understand the buying power of the $850,000 now. Does that mean you really have a value of $770,000?
Yeah, if you're going to go out and spend all that in today's market versus a year ago, then the answer to that would be yes. Of course, this is all spread out over time, so that wouldn't be the real impact. But you could interpret it that way if you were to go out and spend all that money at once. Yeah.
Would that not be another hazard with withdrawing that money right now by not letting it stay in and grow?
Yes, with withdrawing that money, you would bring down that average investor 3.5.
Yes.
Yep.
Thank you.
John, I don't really have any specific questions, but rather just wanted to open up to your thoughts. If you had any thoughts you felt compelled to share with regards to the midterm elections coming up so closely around the corner here. I know you brushed across that, but if there was an opportunity to give any wisdom and a crystal ball vision based on a couple of potential directions that could go, I'd love to hear those thoughts.
Sure. So I still think in general, the markets are pretty agnostic to politics. There just happens to be that the closer you get to the election, I think the same could be said about the 4-year election, right? But the midterm election is the one that you can see the charts for. And I showed you a few moments ago. That's just that people get a little riled up as we get closer to the election. Volatility increases, especially on the downside. And then the election happens. Everybody's at ease. Okay, it's behind us. And then people buy back in and you see the markets improve. I just think that it's part of that emotional chart more than anything, not so much the politics or what one party believes over the other. I think it's just the emotions tied to the election. All right. Again, I want to just thank you for taking some time out of your afternoon. I hope it's at least as nice there as it is here. Feel free to reach out anytime. If you're feeling the pressure the media wants you to feel, that's a good time to reach us, phone, email. We can set up some time anytime. But thank you again for your trust and confidence in our team. We work diligently to make sure that you have great positions in your portfolio. We won't always be right, but we'll do our darnest to keep you on track. So thank you again. Have a great rest of your Monday, and I look forward to speaking with you soon.